everyone, welcome to a new video on RRGs, relative rotation graphs and markets in general. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. This week I want to address definitely asset allocation through the RRG lens and also look at what's happening in sector rotation, but then in terms of growth, value and size. Let's go. Here is the weekly RRG for asset allocation. I have switched off the Bitcoin tail because it is very far out. I'll bring it on right now here. You see Bitcoin very far to the right, which is obviously because of the recent strength, but right now it's going through some sort of a correction, heading into the weakening quadrant at that very long tail. So that's really distorting all the other elements on this chart, which I want to talk about. Let's get the stocks versus bonds comparison out of the way. We've got SPY here on the right hand side, which is strong. Right is good, left is bad. And we see government bonds and corporate bonds here on the left, far on the left, and high yield a little bit closer to the center. The headings for SPY is down and for the fixed income stuff is up. So we have, well, looks like a negative heading for SPY. It's very stationary. And we've got some positive headings for fixed income. The problem is that the RS ratio axis is dominant. And so we have to conclude that stocks are still to be preferred over those fixed income asset classes. But what's more interesting, I think, right now, what's happening right now, because there's really something happening, is the enormous strength for commodities. We haven't seen that for a long period. And look at the tails for GSG and DJP. These need to be investigated because this is a outstanding rotation, very, very strong, moving from improving into leading at a very strong RRG heading. And then there's the US dollar, which lost some of its momentum, but is continuing to move sideways to the right. So that means higher on the RS ratio scale. And that's a positive thing for the US dollar. So let's look at a few of the individual charts here. So a quick look at the weekly chart of SPY. You see that it is still captured in that trading range. However, last week shows a strong week with a close towards the high of the week, pushing against that overhead resistance, let's say around 610. That's going to be the line in the sand. If we take out 610 to the upside, that's probably going to trigger a renewed acceleration for the stock market. And then for government bonds, you see the falling trend. A little bit of a hiccup over the last couple of weeks, but it's not convincing. It's not really convincing. And you see how relative strength is pointing lower. The last bit is that positive heading that you see on that RRG. But you can also see how low the RS ratio still is, keeping government bonds on the left-hand side of the graph. So pretty much underscoring the still overall strength for stocks, or not so much strength, but preference for stocks over bonds, over government bonds. And then here are corporate bonds, LQD. You see a very clear rhythm of lower highs and lower lows, pushing the yields for corporate bonds up, just like GOVT is pushing the yields for government bonds up. And that's why it is keeping those bonds on the left-hand side of the graph. Look at the very low reading on the RS ratio scale. The recent pickup is causing RS momentum to pick up a little bit, but it's still far too early to call for a trend change in both government bonds and corporate bonds. A high yield is a bit of a different situation. You see how high yield, HYG, it has been moving up much more in line with the stock market, which is normal for high yield bonds. It's the highest class of risk. And despite the fact that both RRG lines, so RS ratio is still below 100, RS momentum has moved higher. They are both moving up, creating that positive heading. But what's also interesting is the possible formation. This could turn out, and beware, watch my wording, it could turn out into a small head and shoulders continuation pattern. That would happen if we would either stay here or have maybe one more lower kind of in this range here, and then take out that neckline. That would be a positive sign for high yield bonds. And very likely that would also be a positive sign for the stock market as a whole. Now here's the chart of the US dollar, the US dollar index. And we've seen the break out of that broad range. My fat arrows are still on the chart, marking the target based on the height of that range. So we saw the initial rally and we're now testing the old resistance area as support. So this is a very important support area for the US dollar. We should not drop back below 106.30 and 106. That would sort of void the positive outlook for the US dollar, so be careful about that. If we bring that to the euro dollar chart, you see a similar pattern, although it is inverted. And that would mean a break of 105 to the upside would be negative for the US dollar, because this is an inverted chart. A break above 105.30 would mean strength for the euro and weakness for the US dollar. If that happens, we will very likely see a rally back to the upper boundary of that range, which is around the 111, 112 range, which is a pretty big move in terms of euro dollar. For the time being, the relative strength, as we saw that on the dollar index chart, is still in favor of the US dollar in the asset allocation sphere, but I am certainly keeping an eye on 105.30, 105.35 in the euro dollar chart. And then here is the most interesting asset class at the moment. So this is GSG, that's the S&P GSCI Commodity Index Trust. It's an ETF that tracks that S&P Commodity Index. Few things. So here's the relative strength versus VBINX, and that has broken above that falling resistance line a couple of weeks ago. And the RRG lines are pushing higher, and it's creating that long tail on the RRG. GSG is still below its overhead resistance. That's around 23. So the previous high here is 23.32. So that's definitely the line in the sand, but I'm going to say that it's probably more around 23.20. When we take that out, we can certainly look for a move towards the highs here, which is around 25.75, 26. But if you look at DJP, which is the Bloomberg Commodity Index, that has broken out already. So this could be the prelude of also GSG breaking out to the upside. The relative strength in the RRG lines are showing a very similar pattern, but this is a very strong sign. And if you look at the potential move here, then I think the first area of resistance is around 37.75, but then we can certainly gun for the area around 40. So summarizing the overall picture for asset classes, I think that stocks are still to be preferred over government bonds. We looked at the charts. The US dollar is still in good shape. It should not take out 105.35 in euro dollar terms. And commodities are probably the asset class to watch. They're breaking out or on the verge of breaking out, and they got plenty of upside potential. Let's take a look at the rotation of the various growth, value, and size segments. This is a predefined chart on the RRG page. It's called growth, value, size. And what we see here are growth and value indexes, but also these indexes subdivided into large, mid, and small caps. And that's giving a pretty good picture of what's happening in the markets right now. The benchmark is the Dow Jones US Index. It's the entire US market, broken down into the segments as I just described them. And what you see here is interesting. Inside the leading quadrant, we see Dow Jones US large cap. This is large cap growth. This is growth. This is small cap growth, and this is mid cap growth. So everything on the right-hand side is growth, and predominantly, so in the leading quadrant, it's large cap growth. So large caps in general are doing well, and growth in general is doing well. Let me highlight that for you. So if we would say growth and large cap, that's those two. So large cap and growth. And as a result, you will see that large cap growth is doing well. That's not a surprise, but it's probably the best segment in the market right now. We have mid cap growth, which has the highest RS ratio reading, but it's at a negative heading right now and moving into weakening. And we've got small cap growth, which is also inside weakening and rapidly heading towards lagging. Both of them still have the opportunity to curl back up and do a leading, weakening, leading rotation. On the other hand, we have everything that's related to value and small and mid cap inside the lagging quadrant. Let me highlight that for you. So we have value. Let me put you value and growth. So here is value and growth in opposite rotations, clearly in favor of growth. And if I do mid cap, small cap, and large cap, you see the preference for large cap. So large cap is moving into leading, and both small cap and mid cap are moving into the lagging quadrant. And if I now do the segments, so I do small cap value, large cap value, mid cap value, and I also do large cap growth, mid cap growth, and small cap growth. And here you've got your breakdown into sizes and growth and value. And you can see how growth is still dominating, especially the large cap segment, and how value is lagging. Value large cap is picking up a little bit. I think that's tailing, piggybacking on the general improvement for large cap stocks. So even a few of those value stocks will pick up, but the weakness is definitely in the small cap and mid cap stocks in both the growth and the value segments. So all in all, dominant segment is large cap growth stocks. Growth large cap is probably the best segment in the market right now. Again, I probably have to say. When we take that to the daily chart of this group, then we see that we just saw that the large cap growth was kind of rolling over a little bit. But here you see that the daily version is already picking up again. So here's large cap growth, this is large cap. They're all inside the improving quadrant at a strong heading. So they're underscoring the strength for that group for large cap growth. You see how mid cap growth is rolling over, but still on a very high reading. And then you see all the value stuff. So here is growth small cap. That's inside the lagging quadrant. So growth small cap is actually rapidly moving into the lagging quadrant. That's the only segment in growth that is not participating. So here is large cap growth, here is mid cap growth, and then you see small cap growth moving out of favor, together with all the value stuff, value mid cap in general, value large cap, and value small cap. Again, this is underscoring the strength for large cap growth stocks, again, on the shorter term time frame as well. And to wrap up this video, I want to share two charts out of this group with you in detail. So this is the Dow Jones US Large Cap Growth Index, and you see that very strong trend. Obviously, it looks a lot like the S&P chart. Inside this consolidation, when it breaks higher, that will definitely be a good sign. Support somewhere around 8,200. But just make a mental memo of the relative strength line of this large cap growth index. It's on large, moving higher, moving a little sideways here over this period. That has caused the RRG lines to drop. They're now picking up again. But now keep this chart in mind, and now we will switch to the large cap value index. Look at this relative strength chart. That is a downtrend, and it is still continuing. You see a bit of a pickup here, but look at the low reading of the RS ratio value. We need a lot more relative strength before value can take over from growth again. Here also you see that there's a much bigger dip in the price chart of the value, large cap value index. We are back at the peak area, but it's a lot less condensed than the growth index. I'm going to leave it at this for this week. So from an asset allocation point of view, don't forget to look at commodities. The top 5 sectors have been written about in my most recent blog. It's been dominated by communication services. We didn't talk about that, but you can read all of that in the best 5 sectors area. And then in the growth, value, and size segments, it is definitely large cap growth that is dominating the market at the moment. Thank you for watching. I hope you enjoyed the show. Let us know what you think and share your thoughts in the comments as usual. And I'm looking forward to seeing you again in a new video next week, same time, same place.